this particular panel, we have 4 esteemed speakers. They promised to only go 45 minutes each, and then we'll serve the lobster. The topic that we had, very simple question: do deficits matter? And it's a wide open question to get the perspective from each. So I'm going to turn it over first to Constance, and then we'll just go down the line and get perspective.
Okay. So I'm going to do deficits matter. The short answer is yes, but probably not in the way that you think. So, and I'm going to just preface this and level set by saying I spent most of my career very much in the camp of like, oh, we shouldn't have high deficits. The master criterion of 60% makes sense. You really want your primary deficit maybe to be 1-2% of GDP unless you're in a crisis, and then you could get up to 3.5%. You also, the corollary to that, want your tax code to be pro-cyclical. So what does that mean? That means that in good times and when people and companies are doing well, you're collecting more taxes. Example A would be the late 90s, when we collected a large number of capital gains taxes that allowed us actually to have no budget deficit in the in 2000. And forecasts were like, oh, well, this will just go on forever. People didn't realize it was just the pro-cyclicality of the tax code. And we have lost that after the Tax Cuts and Jobs Act. And so I don't think that that is a particularly good thing. The problem is we have one party that refuses to tax, and we have another party that doesn't seem to want to rein in spending, and that is not a great combination. However, everything that was said about why we shouldn't be spending, not everything, but a great deal of it turns out to be wrong. Oh, and if I take my hand off this, we're screwed. But this book I have in my lap was written in 2017 by 2 guys at the conference board, and it goes through this litany of things of why, what will happen to us if we don't fix the deficit level and the debt level. And this is 2016, 2017, right? We're coming out of the global financial crisis, we're having slow growth, and they're saying, well, we'll never get productivity growth if we don't do this. Well, what are we having now? We're having a productivity surge. And we're having a productivity surge because, in part, the pandemic changed the way we behave and changed the way companies behave and forced new behavior, but in part because of the investments that are being made, and in part because of where we are in the technology cycle. Then you look at a country like Japan, very significant deficits, very poor spending. So what you spend on matters, right? You have to spend on things that are going to have positive multipliers and positive externalities. And that leads me to one point about defense. I was asked to give a speech on defense spending and the economic impact of defense spending earlier this year. So like any good economist, what did I do? I did a lit review. And there are about 168 papers, all detailing global impacts of defense spending. It all is negative for GDP. And I thought, this can't be. Like, there have to be positive externalities. So I went specifically looking for papers on the impact of the DARPA grants. So is everybody familiar with the DARPA grants, the technology grants for the military? So this is, we've gotten many things out of the DARPA grants. We've gotten the internet, fax machines, semiconductors. Microwaves. No, microwaves were not a DARPA grant. Microwaves were Northrop Grumman was working on the microwave technology because it was a jamming frequency, and they were trying to jam their communications so the Russians couldn't spy on us, and the guys were bringing their lunch to work. It's like the 50s, they're bringing their lunch to work, and all the days where they were working on the microwaves, their lunches ended up being cooked before they sat down to eat them. And they figured out that it was cooking the food, and then Northrop Grumman ended up selling the technology, I think, to GE. And that's how we have microwaves.
Close enough to
Close enough, yeah, close.
Adjacent.
Defense adjacent. Okay, 2 more minutes. I can make it less, or fewer. In any case, so there's not enough work on DARPA and its impact. Then I found a study that talks about the impact of military CEOs, so CEOs that have come out of the military, and there's some positive impact there, but interestingly, those CEOs do not engage in a lot of CapEx. And we know that CapEx is what's going to, well deployed CapEx is what is going to get us productivity and technology advancements. So I think there's more work that needs to be done on this. I'm on the board of NBER, so I've talked to Jim Paterba about how we are going to start specifying some papers that need to be done and studied so that we can have a better idea, because we are entering a phase where there's going to be more military spending, not just in the US, but in NATO and perhaps around the world. And so if we can make sure that our military spending has more positive externalities, that is certainly a good thing. So I will yield the rest of my time.
All right. Let's see if I can get this to work. Here we go. All right. So I want to ask more questions because I don't have a lot of answers, but I'm very much. Is this working? Yeah. 1, 2, 3, 4, 5. I need you to help me. All right. I need a mic. I'm a prima donna and I have to have a mic. So I was very inspired by. We'll have a side. I was very inspired by our survey this year because something that is very rare in our industry was included on many of the questions, which is the answer, I don't know. We work in an industry, whether you're in finance or investing or economics, that is notoriously uncomfortable saying what is very often the only right answer, I don't know. And so because of being inspired by that on that, I'm going to ask a few questions where I honestly have a hard time giving an honest answer, but at least it'll be thought-provoking amongst the group. So 3 questions I want to ask, and that is simply, why is debt bad? How much debt is too much? And of all the metrics people who have been warning us about debt have given, how have those metrics done over the ensuing years, decades, etc. So the first question, why is debt bad? I really had to scratch my head for a while, and the only answer that was moderately satisfying was, well, the Puritans came to America, puritanicalism, they don't like anyone having fun, it's sinful, you will go to hell. If you borrow money rather than saving up to buy something, this is not appropriate, this is not the way the Puritans want. And there is this long-standing cultural belief system in the United States that debt and fun is bad. And you see it not only in the movies like Footloose, but in the constant drumbeat of the deficit hawks about all debt is bad. My experience hasn't been that way. I buy a car, I pay it off, debt allowed me to do something I might not have been able to do. I'm pretty sure most people in this room who have a house borrowed money on a mortgage and paid it off. And for a sovereign nation with its own central bank, standing army, and printing press, there has never been a solid explanation as to why debt is bad, at least not one that I haven't found persuasive. So if debt isn't necessarily bad on its face, well, is, a glass of wine is nice, but 6 or 8, maybe there are problems. Is too much debt a problem? How much debt is problematic? And again, I have to answer, I don't know. I've been told by a lot of people, more debt is bad. Well, can you put a number? More is sort of ambiguous. Reinhard Rogoff come out with a study, 100% debt to GDP
90.
Is bad. Oh wait, we have an Excel mistake. It's not 90 or 100. We're wrong. Where's the US now? 129 or so? Is that about right? Gee, that sounds a lot more than 90 or 100. Is that bad? I don't know. Japan is 257 debt to GDP rate. They seem to not have problems paying their bills. So if 90 is not the number, and 129 is not the number, and 257 is not the number, what is the number? I don't know. I'm pretty confident it's not 1 million. Maybe it's 1,000. I don't know. All I know is that all the numbers that people have sworn up and down will be the end of the country if this is the debt to GDP ratio have all proven false. And to keep this within this short period of time, let's go to the third question, which What are the metrics which people have sworn that if you continue to deficit spend, here are the problems that you will deal with that will be the end of this country. And we were warned that deficit spending is going to crowd out private capital. It will choke off innovation, end new company formation. It will send the costs of federal borrowing skyrocketing higher. The debt will become impossible to manage. The US dollar will be radically devalued against all other countries. That will devastate the US economy. It will cause rampant structural inflation, spiking price levels to areas never seen before. It will act as an overall drag on the economy. Now, this isn't things that I heard about last year or during the pandemic. I've been out of high school for about 50 years, and this is the stuff that we were being warned about in the Carter administration, in the Reagan administration, in the Bush administration. If you deficit spend, here are all the terrible things that are going to happen. And what the subsequent experience has shown us is private capital. There's more private capital in the U.S. than there's ever been in history. You can debate, is it 50 trillion, is it 100 trillion? There's certainly an endless amount of private capital. The United States continues to be one of the most innovative countries in the world. And as we saw spike during the pandemic, new company formation not only spiked new highs, but it has persistently stayed there. We are creating small, agile, innovative companies at a rate we've never seen before. The cost of subsidizing or covering the U.S. debt has gone up, not because we've deficit spent, because the Fed said, hey, this temporary transitory spike in inflation requires a 525 basis point hike over 18 months. But for that, we have enjoyed very low rates and very low inflation for the past 20 years. King dollar might have stumbled a tiny bit over the past year, but if you have a couple of billion or a couple of $1 trillion to put away for the next decade, it's going to be the Japanese yen, the euro, the Chinese. Where are you going to go other than the dollar? Every claim of the US dollar being devalued has failed to come through. The US continues to enjoy borrowing money at relatively modest rates. Every warning the deficit hawks have given us have proven to be false. They are Chicken Little. I don't know how much debt is too much debt. I do know that we've been fed a steaming pile of bullshit for the better part of the past half century, and I'm a big fan of going back to first principles and saying, if you say this is going to happen, and it doesn't happen, why should I continue listening to you? And I'll leave it at that.
So I'm partially sorry to disappoint, maybe not everybody, but at least some people, because if you know me, off record, I have plenty of thoughts about this issue. But I'm also an objective, hard news reporter who has no opinions for a major national outlet. And because of that, I'm very limited, I'm very circumscribed in what I can say here. There are a lot of very smart people that can be more forceful and opinionated and unequivocal in what they have to say. So I'll let them take the reins there. But what I can say, also thank you for holding this. This looks like a whole
Pay it forward.
I just think, as somebody that writes for the general public, right, I really respect and learned a lot from plenty of journalists that essentially raised me, who write mostly for the investing class. I don't. I write for the general public, and I think we take for granted the fact that a lot of us that are here know how money actually works. But like most of the country, like they don't actually know how money and the financial system and macroeconomics work. And if you do know how money actually works, politics aside, all of us here have different politics. It's just important to actually be talking about what we're talking about. And I do think, even as an objective news reporter that has no opinions, that we have reached a place where, I feel comfortable saying on record, in public, inflation is the constraint of government spending and government finance, as long as you are in control and issuing your own currency. And that does not mean that the government can spend willy-nilly. It does not mean that there's not opportunity costs in terms of investing in this versus investing that, versus subsidies for this versus subsidies on that. But if we start from, you mentioned first principles, and I know that's become kind of a hackneyed thing because a lot of annoying tech guys have started to use it or overuse it. But there is something about this idea of, okay, yeah, first principles on first base, just working from, a baseline. It fundamentally changes what voters, Congress people, Fed chairs, anybody and everybody is talking about. If we can all agree that, for example, to bring this into firmer terms, if we look at, inflation expectations, break-evens, they've been crashing, depending on whether you're looking at the 2, 5, or 10-year horizon during this year. At the same time, if you look at at CBO estimates, if you look at private sector estimates, structural deficits are expected to grow quite substantially. In some circumstances, double. So, okay, if we can say Treasury supply matters, I think that's reasonable. Of course, it matters in some sense. You can say deficits matter, yes, in some sense, but how could it possibly be if there is a tight correlation between deficits and inflation, then what we're seeing right now just fundamentally shouldn't be able to happen. And so I feel like that is a real life, live experiment evidence of the fact that regardless of your politics, you should be gearing how you want to structure society and markets towards how do we create the best outcomes for people, how do we raise the baseline standard of living for as many people as possible, and do it without stirring inflation. And as far as I've been able to see in my career, it does not have a tight relationship with how much has the government spent in a given year versus how much has it taxed back.
All right.
I want to kind of pick up where Barry kind of took this conversation, but kind of answer this in a little different way. Yeah, I don't know what the right level is. I do know, the only people I've really seen do some work on this recently was the Penn Morgan budget model. They put a little paper out in October that basically said federal debt held by the public, you got it to 200% of GDP. That's really where you start crowding out and really having broader U.S. economic problems. So we're at 100% right now. They had a neat little chart that also said this is really dependent on interest rates too. So, in their view, we had about 20 years to really kind of fix this problem. So that's kind of my starting view. I do think, that debt level is about 100% of GDP. We're basically the same way we were in World War II in 1946. So we are kind of, the last 50 years we've been, 40% in the Reagan era, I think 60%, prior to COVID. It's really, the chart in the handout shows how this is just ratcheted up. And we are kind of in an unprecedented era. But, your point, some of the things that everybody expected from that just hasn't emerged. To take this a step further and talk about defense and where defense spending is, the U.S. certainly has the capacity to increase defense spending if we want to. U.S. defense spending right now is around 3% of GDP. It's around 11% of federal outlays. Where debt and deficits have mattered for defense really have been around these episodic outbreaks of congressional attempts to try and rein in debts and deficits. And that occurs typically when the deficits are around 5% of GDP. You see these things like Graham-Rudd and Collins, the Budget Control Act, the Fiscal Responsibility Act of the 1980s, 2011, and the most recent one is 2023. Congress will try and put budget caps on and then promptly lower them about a year or two later. I think we're going to see the same thing play out. Right now, if you look at U.S. defense spending, the plan that had been submitted by the Reagan administration shows it going about 2% nominal, so basically no real growth in defense spending. Places like Japan, with much higher debt burdens, are really talking about some of the highest defense budget growth rates in the world. Europe, I think, as you're aware, is also significantly increasing their defense spending. And countries like Poland, you know, that you think would have some fiscal constraints, are taking defense spending up to 4% of GDP, which is twice the NATO target. So if you live in a bad neighborhood and you see bad things happening, some of the fiscal constraints go right out the window, and you worry about really protecting your own society. And when that starts to happen, security will take the priority. I can talk more about some of the specifics, kind of where I see different issues going in defense, and you know what I observe about global markets and where people have been placing bets around the global defense industry. But maybe it's best just to open this up to questions and comments and get the discussion going that way.
Great, thank you all. Thanks, panelists. So we're going to take about 10 minutes rapid fire Q&A. Rick, please.
Could the United States double its defense budget if it had to?
Absolutely. I mean, yeah. Senator Wicker put out, he's the ranking member on the Senate Armed Services Committee, put out a paper in the last couple of months talking about taking defense spending up to 5 to 6% of GDP. You know, that would put you, if we're around $850 billion right now, that would take it to $1.7 trillion. You know, again, then you're going to have the broader question about what are you going to cut? Are you going to raise taxes? You know, in theory, you could borrow more to do that, and that would probably that would pull that Wharton, you know, due date a couple of years forward, but it could be done. The more interesting question is, do you have the capacity to do that? Can you know, add another 1 million people to the armed forces? How is industry going to deal with that? Is that where you start to kick in some of the inflationary pressures if you really go for a rapid defense build-up?
I'm going to follow up with that. I just want to ask you as the defense expert. Look, we could double the size of the U.S. budget. Do we need twice as many Ospreys that don't fly?
Yeah.
Having spoken earlier, how should we be spending that money that we already have? That is the equivalent of the next, I don't know, dozen countries combined?
One of the central problems, you know, let's just do away with it.
All right.
Can you hear me in the back?
Yeah. No.
So one of the things, a central problem right now is that it just takes too bloody long to build stuff. It takes about 8 years to build a nuclear submarine. A typical major weapon system is about 56 months. I mean, it's so out of kilter with timelines of what you really need to deter countries like China. There are some interesting programs going on in the Department of Defense right now. There's a program called Replicator, where they're trying to really scale and build drones in an 18-month time frame. There's a whole concept called Hellfire, where you're going to, you know, flood the Straits of Taiwan with the types of drones that Ukraine has been using in the Black Sea against the Russian Navy. There really isn't a Russian Navy anywhere in the Black Sea. So there are those approaches going on. It's going to take time. You know, I think we're going to see a lot more of that in 2025. You don't hear a lot about it because a lot of it's classified.
So it's not just the dollar amount, it's how the money is being
It's
spent.
how the money's being spent.
Yeah, and this book talks a lot about the way that procurement occurs and efficiencies within the military that needs to be fixed. And so there's a number of ways that the military wastes money that we could spend more efficiently than we do now.
Sustaining capitalism.
For sale in the lobby.
Absolutely. David, and then David.
My question is that I see all these statistics about interest on the national debt growing and growing and growing as a percentage of federal spending. Eventually, I might have seen a statistic that by next year or the year after that, it will become the #1 item.
It passed defense this year.
Okay, right, and it's moving up to entitlements, right, pretty quickly. So eventually, it's going to overtake it if the spending, if the deficits continue. I mean, at that point, don't you just start entering a vicious cycle? I mean, where, you know, you're now crowding out certain items that you would otherwise want to spend for. And isn't really, really the only solution for that is
Lower rates.
Or
Or
run
raise taxes.
primary surpluses.
Right.
That's my question, it's a comment.
Right, it's a mix of, so we can all address that, it's a mix of how much are we taxing? You know, the United States is amongst the lowest taxed industrial Western nation. I'm happy paying as little tax as I pay, and I am very cognizant that I am probably never paying lower taxes than I paid this year for the rest of my life. That's a given. It's not just how much we spend, but it's how we spend. And if you look at what's taken place in the Pentagon over the past 50 years, it's become a corporate welfare department. It has nothing to do, or much less to do with the national defense. Someone needs to come along and say, let's do this whole thing, start it over, build it from scratch. And you could probably do that in every major government organization, but there are no organizations that matter as much as the Department of Defense to our security.
Does anybody want to take that from a?
I would also say we want to return our tax code to being pro-cyclical. It is ridiculous that we are in a boom economy and we are not collecting more taxes.
Right.
And that that's not happening automatically because of the structure of our tax code.
Taxes. Dave Person, please.
Just put that anywhere.
I don't know that I can follow that. This is mostly for Constance and Byron. Doesn't does what is spent matter? So the deficit. I'm saying this well. If the deficit is used for consumption purposes, won't the impact be very different than if the deficit is being used for investment purposes?
Yes, obviously.
Well, yes, obviously, but deficits don't matter.
No, that's not what we said. And in fact, I think the thing is that when it was black and white, when it was you shouldn't go above 60 or you shouldn't go above 90, it made it easier for politicians in a democracy to kind of say, well, we have this constraint on us, we can't go beyond. And now that we've discovered that might not be true, we know there's a constraint.
Somewhere.
We know that what you spend on matters, right? But without it being black and white, it actually makes it trickier for politicians to sort of color within the lines, so to speak. But it still obviously matters. The problem is it's not a crisis.
And I'm going to put a little color on that. We know when we build highways or redo airports or spend money in a way where there is a multiplier effect in the economy, that classic Keynesian stimulus has an obvious knock-on effect. What has happened over the past 30 years has been this weaponized Keynesianism where we take the Department of the Pentagon defense spending, and rather than say, what are the systems we need to defend ourselves, we say, how can we build something where we're putting a plant in each congressman's district to get this through and make something that should cost $500 million, cost $3 billion, but we get it approved because of this ass-backwards procurement method, which is, I personally think these places would be better off more bridges, more highways, more schools, more libraries, useful societal things, and let the professionals in the Defense Department say, we need this, and we don't have to spread it across 47 districts to get it approved. It should be removed in some way. Here's how much Congress is going to give us, now let us go buy the ships and planes we need. As opposed to it becoming a, sort of pork belly.
Yeah.
And I'm sure you can talk in greater detail than I can, how far afield it is today from what was done during World War II and during the Cold War with Russia.
So lots of questions, lots of discussion about defense spending. Why are you not talking about transfer payments? That's
Why
where
are we not talking about
transfer payments? That's where the big increase in spending is.
Well, so I can take that. Transfer payments, essentially, if you look at non-interest, non-mandatory, non-defense spending, and really, let's be honest, defense is mandatory spending. Could we have procurement, that is more
Right.
smartly done, of course. But I think both left, right, whatever you want to call people. I don't think anybody's going to actually be politically viable if they're trying to say that we should actually scale back the U.S. military's presence. So let's also drop them mandatory. Okay, you strip all that out. You're talking about, pennies on the dollar in terms of our budget. So when people talk about, let's talk about transfer payments, let's talk about entitlement, that's fine. You can talk about it. There was a large segment of Wall Street, there was a large segment of the think tank world that wanted to roll back entitlements and say, look, we made these promises to you, we can't keep those promises anymore, we're going to be honest with you about that. And you had them, but your niece, your nephew, your grandkids, maybe even your kids, they're not going to be able to receive the same level of benefits that you did in terms of Social Security or Medicare. You can theoretically do that. It would be a very hard sell for any of us in here, at a hunting lodge, with a very, 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 very far above average income as Americans collectively, to try and sell people on the idea that as we're literally right now in the middle of the largest wealth transfer in the history of not just this country but the world, that will not necessarily be oligarchic, but will essentially instantiate wealth for an entire generation, to say, while that's happening, you're not going to be able to count on the sort of wealth or just baseline of certain dignity that a generation before you had. You can mechanically do it, and there are budget challenges if you do not roll back some of those benefits. But yes, either you're going to have to tax people more, or you're going to tell those people that are, maybe not necessarily our guides, but the folks that work in retail, however many miles down the road, you're not going to get those things. Or, you get more comfortable with the sort of things that we talked about last night. Do we start talking about MMT, post-Keynesianism, whatever we want to call it, where it's just like, no, let's stop judging our budget based on an Excel spreadsheet based on, does this budget balance? Should we start talking about what we really want as workers, savers, investors? Is, does our money keep its value over a course of certain years? And that is an uncomfortable conversation, but a real conversation that probably within the next 10 to 15 years, reporters, investors, and whatever think tankers are going to have. So again, I just, there's a certain limit to what I can say in this public filmed setting, but we're definitely at the point where I think it's time to actually talk about what the we're talking about. You know what I mean? There's way too much cable news and way too much journalism that is, print, digital, otherwise, that is not fully talking about those exact realities. Because you're right, it is tough, because how are you going to keep those transfer payments going if we're not acknowledging these other conversations?
Let's go Kendall, and then we're going to Eric.
Barry, this goes over to you, because you actually had studies that kind of follow up what you said.
Sure.
So have you seen anything that talks about over the history of debt and the history of taxation, because first income taxation was post-Civil War, I believe, the productivity versus non-productivity of the debt that we take on in the U.S. government, because there's a component of that, and has that changed over time that leads to where we should be or where we should not be?
You are in a room full of people who can answer that question so much better than I can. That there are plenty of experts here, and I would defer to them. That is a little outside of my purview.
Anybody want to take that?
So you were asking about what are the more productive uses?
Over time,
Return on debt. How much growth are you getting with debt?
That would become more productive or less productive in the debt we're taking on in regards to what it's going to provide for the society. Because there's obviously there's a lot we do in society that creates productivity. There's a lot that we do that does not.
Yeah. So in analyzing there's what we call in economics a time inconsistency problem. So it's very hard to tie specific pieces of debt that we've taken on to specific government programs, although what we are doing now with the Inflation Reduction Act, the CHIPS Act, and the Infrastructure Act, focused on reducing greenhouse gases and carbon emissions, has a counterfactual that we don't talk about, which is that if we don't do anything to limit that in the next 25 years, we are looking at a radically worse equilibrium for the U.S. and the global economy. So,
it's statistical analysis only, though. I mean, there's a model that gets to that, not actual factuals. There's no factuals that say this is a guaranteed. There's a model that we all follow models, and we know sometimes they're wrong.
well, that's true, but we are definitely seeing all models are wrong, some are useful. Thank you, George Box. But the fact is that we are seeing increased climate volatility, and we are seeing the impact of that on businesses. We are seeing it on insurance, right? And so that is happening. So,
Okay, 2 more questions. We're going to Eric and Jack. Did you have a question? Okay, and then
So,
Jim.
Barry, the question, why does it matter? Is debt bad? To me, I think it comes down to thinking of, well, the world's largest corporation and what's the fundamental value of it. How does debt, and just picking one line item on a balance sheet seems obtuse. Apple has $106 billion of debt. Who gives a shit?
Right.
Because it matters that the free cash flow, the bottom line, is what matters. So, is it the bigger question? How does it affect the fundamental value of the United? Does the debt affect the fundamental value of the United States?
So you're raising 2 really interesting questions, and I'm gonna raise the one that you didn't directly state, and then we'll go to the second one. Every time we have these conversations about debt and things like that, you're looking at one half of the balance sheet, and the other half of the balance sheet is what is the productive output of the U.S. economy, right? I saw a chart the other day that I had to throw up on the website that said, look, we had $1.3 trillion in debt in 2009, and look, now we're at 1.9 trillion, and this is all a record issuance. And aside from the fact that inflation adjusting 1.3 from 09 to today, you don't realize we were 305 million people a few years ago, and now we're 341 million people, and the economy pre-financial crisis was 15 to 16 trillion dollars, and now we're a 26 trillion dollar economy, and we have seen no signs that the growth engine of the world, that is the U.S. economy, is in any way slowing down. All right, Noah Smith said the U.S. missed battery technology, and China owns that. All right, there's one tech that we haven't been a key driver on, but look across the board as to what has been moving the global economy forward, and in just about every area, the U.S. is, if not a leader, a top 5 participant. So the ongoing growth of debt is not taking place in a vacuum. It's taking place in the midst of a robust, dynamic economy that long since the post-war era continues to be. We are a tiny percentage of the globe's population, 20-something% of GDP, and nearly half of market cap. So I don't think we can talk about debt without talking about the productive assets on the other side. And I see David raising his hand.
I wasn't done with my question.
Final question, Jim, and then we've got to cut it off.
We have lobsters waiting for us, and we have to knock on the kitchen door.
Okay. Jim, go. Quickly, 30 seconds.
Barry, you said we don't know, and I agree with you. All these answers. Is it going to take a Liz Truss moment? Are we just basically waiting for everything to blow up, and then we'll say, okay, we've gone too far? Or will there be any way we'll know before that?
30 seconds, please.
So I think most of us in the room would agree that before Humpty Dumpty comes off the wall, there will be lots of signs of stress in the economy. And again, a lot of you who study different aspects of the market, there are derivatives people here, there are bonds people here, there are commodities people. Signs of that stress will be evident long in advance. Most people won't believe it, but I don't think we'll know until we're much closer than we are today.
Thank the panelists. Thank you.